Hi everyone, welcome back. We're nearing the end of this series, and the next few videos will finish off the inputs before we get into the outputs. In this video, we'll be looking at how the model deals with tax and cash management. First, let's talk about tax. First, the disclaimer. Tax calculated in the model is to give people an idea of the value impact of tax. It is not a substitute for tax advice or preparing a tax return at the end of the year. The model calculates tax on an annual basis and allows for a delay between tax assessment and cash payment of tax. The model also has functionality to reserve cash throughout the year to ensure there is sufficient cash to pay tax at the end of the year. Let's go through the input fields. First, enter your appropriate tax rate. For Australian businesses, please check the Australian Tax Office website if you're unsure, or check with a tax professional if required. Next, the tax year end, which in Australia is typically June. You can also set the time between the end of the tax year and when you actually need to make the payment. This next field lets the model reserve cash for tax payments at the end of the year based on the expected profitability. In other words, this smooths out the cash requirement from your business from a tax perspective. Let's say in this example we want to reserve cash quarterly. Next, turn this on if you expect your business to be able to carry forward tax losses from previous years. And finally, are there any existing business losses that can be carried forward on day one? This only applies if you are acquiring an existing business. Again, please refer to the Australian Tax Office website or consult a tax professional to determine any of these inputs. Next, let's move on to cash management. Note the cash reserve mentioned here does not include the cash reserve for tax payments described earlier. The cash reserves here is what the business used to pay its day-to-day expenses. The first field is the starting cash balance in the business, contributed from its owners. Let's say $50,000 here. Next is the interest you earn on your cash reserve. This is typically the rate your bank account offers you. Let's say 1%. This applies to your tax reserve as well. The next inputs all deal with your distribution policy, basically how the model assumes you, the owner, takes money out of the business. The first field is the month your business will start distributing funds. Let's say you tell the model not to pay you anything until month 18. Next, you can set the minimum cash balance. Let's set this at $50,000. This means where possible, the model will always try to maintain at least $50,000 in the business and will not pay owners if it means your cash reserves drop below this amount. Lastly, you can set a payout ratio, meaning what proportion of free cash will be distributed to owners, with 100% meaning all of it. Let's set it at 50% here. Note, even if you set the payout ratio of 100%, the model will only pay owners if the previous two conditions are not breached. Now, when you go through these inputs, they are not just conditions used by the model to determine when to pay the owners, but you should also think about your distribution policy when you are operating the business. Having a sufficient cash float is important to the early survival of a new business when revenue streams are still thin and timing uncertain. Cash flow also prevents drawing down on potentially expensive debt like credit cards. On the other hand, you don't want an overly large cash balance because that is an inefficient use of funding. We suggest you do some scenario testing to see what level of cash is sufficient to cover potential downturns. That's it for this video. In the next video, we'll be talking about valuation.